What was the super contango event in 2020 oil markets? Imagine a time when oil prices turned upside down and sellers were paying buyers just to take the oil away. That's what happened during the super contango event in 2020. It was a wild moment in the oil markets that caught everyone off guard. Normally, futures prices are a little higher than the current spot price because of storage costs and other expenses. But in 2020, the gap grew into something extraordinary. This all started because of the COVID-19 pandemic. Demand for oil suddenly plummeted as travel stopped and factories closed. At the same time, oil production kept going strong. So, there was way more oil than anyone needed. Storage tanks began filling up fast, and storage costs skyrocketed. In fact, in April 2020, the price of oil briefly went negative. That meant sellers were paying buyers to take oil off their hands because there was nowhere left to store it. Now, to understand super contango, we need to look at what regular contango is. In normal market conditions, futures prices are a bit higher than the current spot price. This difference covers the costs of storing and insuring the oil until delivery. But super contango is an extreme version of this. It happens when storage becomes so expensive and scarce that futures prices shoot up for above the spot price. During this time, traders and companies rented floating storage like oil tankers because land-based storage was full. The cost of storing oil became so high that futures prices reflected these huge expenses. This created a big gap between what you could buy oil for today and what you could sell futures for months later. Some traders saw an opportunity to buy oil at very low or even negative prices and sell futures contracts at much higher prices. But this was risky because of the costs involved and the unpredictable market. The super contango was also driven by the lack of agreement among major oil producers like the United States, Russia, and Saudi Arabia. They couldn't agree on cutting production, so excess oil kept flooding the market. This kept storage full and prices high for futures contracts. In summary, super contango is when futures prices are for above the current spot prices due to high storage costs and excess supply. In 2020, the pandemic caused demand to collapse while supply stayed high, filling storage and causing prices to turn negative briefly. Futures prices stayed elevated because of the high costs to store oil, showing how supply and demand imbalances can create extreme market conditions. For investors, super contango signals a period of market stress, offering potential opportunities but also significant risks because of storage costs and price swings. Usually, fixing this situation requires reducing supply, increasing storage capacity, or drawing down inventories quickly. This event showed how physical storage limits and supply-demand imbalances can lead to extraordinary price distortions in commodity markets.